Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are looking at Advanced Micro Devices Incorporated, ticker AMD. This is a stock that I've never taken a look at before, and with their earnings today, I figured let's take a look at it. I know it's a relatively popular stock, and I used to hold some Intel. I recently sold out of that position for a profit, luckily. And I am still long on Texas Instruments, but I need to look into the financials there. But semiconductors have been a very beaten down sector. So let's see if it's beaten down for no reason and what is going on with this stock in particular. We see a lot going on here. We're looking at the 5-year view. We do see it's trading in the range somewhere between 75 and 100. We did break out of a downtrend that was established the end of 2021, and we're kind of riding this uptrend that started October of 2022 with a touch point as of today's drop. So we'll see if it continues to ride this up to that $100 level, or if we're going to break below and maybe revisit that $75 level. The stock is down 6.5% after hours after these earnings came out, which is a pretty big move. So we'll see what the market is doing with digesting this information. Here we have the company's financials, as we normally do. We see impressive growth in top line revenues, 43.6% this last year, compounding nearly 52%. Great growth top line. Cost of goods is growing as to be expected with top line growth. The compounding rate is just shy of the revenues growth rate at just about 50%. This last year, the cost of goods did outpace the revenues, up nearly 53% compared to that 43.6 that we had seen. Gross profit is growing very impressive, 54 compounding and nearly 34 in this last year alone. Net income did take a huge dive this last year. It has gone up quite significantly since the 2019 financials. So we'll see if they can bring it more in line with 2021. But as I've said, semiconductors have been a tough market recently, and one of the headlines that I read about the earnings that came out is their chip sales were down 64%. So we'll see if that's going to rebound or what is going on with all of that. For expenses, we do see some very large expense growth, growing much faster than anything else that we see last year. Huge jump of almost 75%. Their EBIT did decline massively this last year. It typically grows. 2019 numbers were pretty small, something more in line of what we've seen on some of our smaller cap dividend companies. And they've ballooned from there. In 2022, some of these numbers like the EBIT, it tripled. The gross profit we do see in the 40s. The lowest that we see here was back in 2019. It jumped way up from nearly 43 to 48 from 2019 to 2021 and is back down to 45 come the end of 2022. Net percentage, that is an interesting number. We see it's typically around 5%, but we did see a huge jump to 19.24 in 2021. Something like that would be amazing, but with the growth of those expenses, I don't think we're going to be seeing that anytime soon. And then as for earnings per share, I've been finding conflicting numbers on this. I think some of them are GAAP, some of them are non-GAAP, but for an apples to apples comparison, we're looking at a $3.50 earnings per share this last year, and the expectations of $3.01 for this year. That does give us a current PE ratio of about 24 for that trailing 12 months value, And based on their typical performance, we do see 2021 was an extreme year for them. They've fallen back in line to nearly a 20 PE. On average, it's 31.83. So I feel like we should be able to knock this value down. Just use the typical 20. So that gives us a share value of $70 and a forward share value of $60. Assets, we see amazing asset growth from 6 to 67 in 3 years. Just incredible. Liabilities growing at a much, much slower pace, a third to a quarter of the pace that the assets are growing. That's something we really like to see. Book value, we do have a positive book value, and it is growing from 2.5 to nearly 6.5 over this period. It was down this last year. 2021 was an outstanding year for them, but there are a lot of shares, and we like to look at the book value per share and multiply that times 3 to find a decent valuation on what you would buy or pay for a balance sheet like this. And it'd be a $12 stock, 16 if they can continue at the pace that they have been. The issue is there's a lot of shares, and they have been growing their share counts, and at rather quick rates too. So that's why personally I don't think I'm going to be buying this stock. It's something I'll keep an eye on. The current share price is significantly over what the earnings per share would bake in, especially with an expected decline in earnings. When we get down to the free cash flow isn't anything super impressive. They have been growing it very well, but it's not where it should be for a stock this size. I see why they don't pay out a dividend. The share count, as we already mentioned, growing double digits year over year. Shareholders' equity is growing a lot. Then we get down to the Lynch formula. The Lynch formula says that it is slightly overvalued. I would tend to agree with that. I mean, looking at these numbers here, 70 would be the absolute most I would be willing to pay for a share. Factoring everything else, that would even be too much. Potentially $50. Potentially $50 I would consider. But they need to bring up that cash flow and book value. Let's get into these earnings and see what they have to say about their performance and why the massive sell-off. Here we are looking at the earnings report, 2023 quarter one. I've highlighted the important numbers for us. So we have generally accepted accounting principle and non-GAAP values here. So we can take a look at both of them. Typically, I prefer to go with GAAP, so we have an apples-to-apples comparison across industries, but there's some drastic differences here in their numbers. Revenue, it's the same for both of them, down 9% from last year. We already saw that they typically have incredible growth in those revenues. So that's not really something that we like to see. The prime time for the stock may have been buying it in 2019 or before, and it might have a lot of downside from here. Gross profit we see is down 16%. And then we see that the gross margin is down 4%. Operating expenses are up 29%. Operating income is down 115%. They had a decent operating income last year. It was just a loss this year, giving them an operating margin of negative 3%, down 19%. Net income, they had some last year, operating at a loss again this year, down 118%. I mean, if I were holding this stock, this earnings would definitely give me a concern. I see why it's selling down so much. Yeah, on a non-GAAP basis, we get a negative value for that net income, the operating income down from last year, but they actually post an earnings per share of 60 cents compared to the loss of 9 cents. And then they do a lot of explaining about where they're seeing growth. They use the AI buzzword, building robust AI solutions. This one I find very interesting. Back in college, I did some projects using PyTorch and TensorFlow, and I built neural networks to identify figures in images, which was a lot of fun. And I do like what they're doing here. I'm not sure it's going to have massive applications to most people, but it could play a role in something like self-driving or security at some point. They talk about a media accelerator that's going to power a new era of live interactive streaming, which is a massive growing industry. Between YouTube and Twitch, there's a lot of live streaming. There are some people who make that their whole career. So if they can grow into that, they could potentially see some upside there. And they somehow integrated AI into that as well. It's dynamically adjusting photo quality. Talk about how their new series processors have performance and energy efficiencies, as anyone is going to say. They're trying to bring the ultimate portability and battery life to handheld PC gaming consoles, which is interesting. They're working with a bunch of different computer manufacturers, working with HPI for the Omen 16, Victus 16 laptops. They're going to have Ryzen 9s in them. Lenovo is going to have the Legion Slim 7 with a Ryzen 9 in it, and their Yoga lineup is going to have the Ryzen 7000 series. They co-engineered with HPI a Dragonfly Pro. Samsung has an agreement with AMD for a multi-year agreement to bring multiple generations of low-power AMD Ryzen graphic solutions to the portfolio. Just impressive. If they can maintain the relationships that they have and become the main chip in a series of companies' products, they can definitely take market share. For their outlook, they only talk about the second quarter, and they expect approximately $5.3 billion in revenue, plus or minus $300 million. So somewhere between 5 and 5.6. They expect a non-GAAP margin to be about approximately 50%. And we had seen above, they had talked about their non-GAAP numbers. So non-GAAP operating margin, they're expecting it to go up significantly from where it sits right now. What we're missing was the cost of goods. We do see that has gone from 2.883 to 2.689. So it is down nearly 10%, which is something that we do like to see. With a lower top line, that's not a huge surprise. Down nearly 10%. Seems like they're maintaining their margins decently. We get to the assets and liabilities. We do see that their assets are up. We do see that their assets are up from 67,580 to 67,638. That's something that we like to see. Current liabilities are up a little bit. I did not do all the math to add this up, but it does look like their other long-term liabilities are up 200. Their deferred tax liabilities are down 300. This is down just slightly. This is the same. So all in all, it looks like they're up just slightly on their total liabilities. Stockholders' equity, we do see it has declined a little bit from where it stood last year at this time. And then they get into the segments. So we see that the data centers saw a tiny increase in the net revenue, but the operating income was cut way down, down by almost 2/3. Client was down significantly, like a third of what it was a year ago, and they are operating at a loss for their client services. Their gaming is down from 1,875 to 1,757. Not a massive drop. They do see a nearly 10% decline in the operating income from that segment. Embedded has tripled nearly, moving from 595 to 1,562. And we do see a significant jump in the operating income. And other, they are seeing a larger operating loss, up nearly a quarter from what they saw last year. So in total, they saw that operating loss that we saw up above. Free cash flow is down a third, and that was something I said that I wanted to see, take a look at. It doesn't seem to be trending in the right direction. And their total debt, as we talked about, is up, as are their assets. So I'm going to give it a slight sell. I don't see the really driving factor to drive up the value of the share price, especially if they're issuing shares and diluting the value. I don't see, at least over the next 12 months, this being a very strong performer. And we'll reevaluate it as their earnings continue to come out, and maybe they'll turn things around and be back on their massive growth trajectory. But right now, they're in a period of decline. Chip demand is down significantly, and we're still waiting to see that bounce back. Intel's building factories in the United States, Taiwan Semiconductor, and all the issues in China. It's a very volatile sector right now, and that may pose the ability to buy at discounted values, but we'd have to look at the other companies within the sector and what their market share is to truly determine which company to buy, because I'm not sure that that's AMD. Intel might. I used to always say that Intel was undervalued and was just getting beaten down, but I got out after they cut the dividend, because nearly a week after they said the dividend was safe, they cut it. So just the betrayal there, I left the company, and I don't think that I would consider getting back into it anytime soon. I want to know what you guys think, especially what other companies you want me to take a look at, and I'll catch you next time.